In this extensive conversation, economist Arthur Laffer revisits the economic boom of the Reagan era, contrasts it with the economic performance under Donald Trump's first term, and shares his insights on current U.S. economic challenges such as debt, inflation, wealth inequality, and currency reform. The discussion spans a broad array of topics, including tax policy, monetary systems, trade, regulation, and the role of government. Laffer also offers his perspective on the future direction of U.S. economic policy, including his advice to Trump, the evolving role of cryptocurrencies, and the political dynamics driving economic decisions today. Laffer recalls the early 1980s when, under Reagan's leadership, the U.S. economy experienced remarkable growth, a 12% real GDP increase over 18 months beginning in 1983. He attributes this surge to structural reforms focused on steep reductions in both individual and corporate tax rates. The highest marginal tax rate dropped from 70% to 28%, corporate taxes from 46% to 34%, and the tax brackets were condensed from 14 to just 2, a flat 28% and 15%. These tax reforms, coupled with monetary policies designed to strengthen the dollar, notably through Paul Volcker's leadership, catalyzed a recovery from severe economic distress marked by high interest rates, high unemployment, and inflation. Reagan's success was also framed as a product of pragmatic policy choices rather than ideological accidents, with bipartisan failures preceding the administration dubbed metaphorically as Collapseville. A substantial part of the dialogue focuses on the U.S. national debt, often cited at levels exceeding 130% of GDP. Laffer challenges the common narrative by emphasizing the importance of distinguishing gross debt from net debt. Subtracting intragovernmental holdings reduces the net figure closer to 100% of GDP. He also criticizes the conventional debt-to-GDP ratio for mixing stock, debt, and flow GDP metrics, advocating for comparisons like debt to net wealth or debt service to GDP for a more accurate picture. Despite acknowledging that current debt levels are high and problematic, he argues they are neither existential nor unprecedented compared to historical standards, nor are they necessarily a crisis if managed properly with sound fiscal policies that promote growth. Debt, in his framework, is a tool for transferring capital from savers to productive investments and can be sustainable if the cost of borrowing is lower than investment returns. Laffer discusses historical shifts in monetary regimes, contrasting the stable U.S. monetary system from 1776 to 1913, which featured a private money system backed by gold and silver and regulated only by government-defined dollar values, with the post-1913 Federal Reserve System. He highlights how the move to a public central banking system, abandonment of gold convertibility, and monetary nationalization led to inflationary pressures and economic instability, including the Great Depression. Laffer is optimistic about the rise of cryptocurrencies and stablecoins, which he views as private sector initiatives poised to restore monetary stability and circumvent government mismanagement by offering an alternative, more reliable form of money. The conversation transitions to the sources and consequences of wealth inequality amid inflation and rising government debt. Laffer argues that redistribution through taxation and welfare creates economic distortions by disincentivizing both production among the wealthy and labor supply among the less well-off. Using the economic transfer theorem, he explains that attempts to equalize income strictly through redistribution reduce overall economic output and can result in everyone effectively earning zero income if pushed to the extreme. He cautions that while the poor need help, punishing success to achieve equality is counterproductive. He supports lower tax rates as a means of promoting economic growth, suggesting that history has shown cutting rates on the rich has led to more robust economies and higher tax revenues, while raising rates has had the opposite effect. Laffer describes Donald Trump as a CEO-style leader who, despite public perceptions, implemented substantial tax reforms in his first term similar in spirit to Reagan's, but without causing a recession first, thus forgoing the same sharp rebound dynamic Reagan saw. Trump's tax cuts and deregulation efforts in personal, corporate, capital gains and death taxes, alongside efforts at transparency and workforce incentivization, align with supply-side principles. On trade, Laffer portrays Trump as fundamentally a free trader who wields tariffs and trade negotiations as strategic leverage to encourage reciprocal tariff reductions abroad, rather than as a protectionist ideologue. He acknowledges the pragmatic bent of Trump's approach to trade as flexible and designed to secure better deals that foster freer trade in the long run. The discussion delves into how democratic mechanisms provide economic system resilience by enabling political corrections in response to economic stresses. Laffer sees elections and political responses as effective automatic stabilizers, preventing the kind of economic collapses historically experienced by empires lacking such institutional features. However, he agrees wealth inequality and inflation erode voter confidence and drive populist anger, which can threaten democratic stability. Voters tend to act emotionally, seeking tangible relative improvements in their circumstances over pure economic reasoning, and politicians respond accordingly by promising immediate benefits, often funded through debt and money printing. A significant portion is dedicated to current and potential future reforms in the monetary system. Laffer envisions a shift back toward a price-level stabilization regime akin to the gold standard era, but possibly implemented through modern mechanisms such as a commodity price index or cryptocurrency-based stablecoins. He explains how stablecoins like Tether can maintain fixed price levels by allowing supply to vary to meet demand. Laffer predicts rapid innovation in blockchain technology will enable a secure, transparent, and efficient monetary system that could theoretically offer price stability and transactional efficiency far superior to today's Federal Reserve System. He highlights the potential for decentralized private money to undermine the government monopoly on currency and restore trust in money's value. Laffer criticizes large government spending and big government interventions as primary contributors to economic problems, advocating for a dramatic reduction of government size back to early 20th century levels, approximately 3% of GDP at the federal level. He emphasizes the importance of broad-based, low-rate, and simplified taxation regimes, including flat taxes and property tax limits, to foster free enterprise and entrepreneurial growth. He contrasts current policies that foster dependency and disincentives with reforms he has championed, such as California's Prop 13 and other state-level tax relief efforts. He stresses that government involvement in the private sector as an owner or investor, such as attempts to rescue Intel, is a mistake that often results in inefficiency and failure. Regarding financial markets, Laffer interprets the recent stock market surge as a forward-looking reflection of expected economic prosperity, emphasizing that markets discount future earnings potential rather than past or current fundamentals. He relates the decline of public stock markets relative to private equity and attributes market valuations partly to anticipated productivity gains driven by deregulation, technological advances, notably AI, and improvements in transactional efficiencies, e.g., blockchain technology. He cautions against purely fundamental analysis rooted in historical norms, arguing that market sentiment often leads value in anticipating growth and innovation. Laffer concludes by urging individuals to become politically active and support candidates who favor smaller government, lower tax rates, deregulation, and free markets. He stresses the importance of recognizing that governments reflect the values and engagement of their citizens, and that economic freedoms depend heavily on political participation. Laffer underscores that economic good governance transcends party affiliations and ideological labels. It is about adopting sound principles that promote sustainable growth and prosperity. He encourages facing economic challenges with optimism and constructive activism rather than despair. Throughout the conversation, Laffer describes his advisory role as independent and unaffiliated with government payrolls to preserve the freedom to provide candid economic advice. He distances himself from both political partisanship and bureaucratic constraints that might compromise sound economic judgment. Citing his extensive experience from Nixon through Reagan to Trump, he identifies himself as a pragmatic economist and activist committed to advancing supply-side policies and free market reforms, while rejecting socialist approaches. Despite vigorous debates around economic pessimism, Laffer remains confident in the adaptability of democratic capitalism, innovation in monetary systems, and the capacity for reform to restore economic health.